Shares of Nvidia are up 1,300% in 5 years. That is 14 times your money, a life-changing investment. But when a company grows revenue at 600% in 3 years, competitors smell blood, and the sharks are circling Nvidia's cash machine. Hey Bowtie Nation, Joseph Hogue here, breaking down how Nvidia pulled off that insane run, the new threats in the AI chip wars, and the 10 stocks you need to be watching. Now, this isn't going to be an Nvidia is doomed video. It's about where your next 10x stock is going to come from. And whether you own Nvidia stock or not, you need to see it. First, understanding how Nvidia has dominated AI chips is going to help you understand how the chip wars are developing and why the company's moat may not be as unbeatable as you thought. This all starts with semiconductors, or chips that are the backbone of the complex processing needed in artificial intelligence. More than a decade ago, researchers realized that the type of chips used mostly in gaming, those GPU or graphics processing units, were perfect for the intense level of computing needed in AI. So Nvidia, the leader in GPUs for gaming, also provided its software layer CUDA that locked in the developers and squeezed every drop of performance out of those GPU chips. That hardware and software combination put Nvidia at the right place at the right time in 2022 when ChatGPT released and started the AI boom. Revenue had been nothing special, up just 0.1% through 2023, but has then jumped 595% in less than 3 years since. But then because that architecture and the design behind these types of chips is so complex, it takes years to develop a chip, and that has been Nvidia's moat, an advantage that allows it to charge upwards of $30,000 to $40,000 each for GPUs and $3 million for a single rack of Blackwell chips. And you see that advantage coming through in the company's profitability, its operating margin, which here is the amount of revenue left over after paying suppliers, production, R&D, and other operating costs. It is a core measure of the company's profitability and how it converts its sales into profits through its own competitive advantages like power over suppliers as well as customers. Here we see Nvidia books a 59% operating margin, converting every dollar of sales into 59 cents of profit. That no other company even comes close. Even powerhouse TSMC is behind by 10% on its margins here. In fact, Nvidia's closest competitor in advanced micro devices, ticker AMD, only converts every dollar in sales into about 9 cents of profits. Nvidia has become the king of AI by perfecting its GPU and software, but the chip war is splintering into a new kind of fight. As AI workloads explode, the industry is using specialized silicon, it's different types of chips for price, speed, and efficiency. Here, the biggest threat to Nvidia's GPU chips is the ASIC, the application-specific integrated circuit, also referred to as TPUs, or tensor processing units. Whereas the GPU, even though it was designed for gaming and graphics, worked so well for AI because of that flexibility and the power, ASICs are custom-built specifically for artificial intelligence. These are significantly more efficient and cheaper to run than GPUs because of that customization. Now I'm going to put all these stocks up on a graph later, but this new chip has attracted big tech players, Alphabet, Amazon, Meta, and OpenAI, all developing their own ASICs to compete with Nvidia. Another threat is coming from the FPGAs, Field Programmable Gate Arrays. Now, these are like the flexible Lego block chips of AI. They're not as fast as ASICs or GPUs, but their adaptability and their flexibility makes them ideal for custom pipelines and specialized compute workloads, with AMD through its Xilinx acquisition and Intel through its Altera acquisition, both spending heavily to develop these types of chips. And because AI is going to be used locally on your devices rather than some faraway data centers, Edge AI and NPUs are being developed for phones, laptop, cars, wearables, bringing AI directly to your device. That means instant responses, lower power use, and less reliance on those expensive data center GPUs. Here we have Qualcomm, AMD, Intel, Nvidia, and even Apple in that race to develop these types of chips. And again, nation, this isn't about Nvidia collapsing. It's about the AI chip market splintering into the multiple profit pools, each driven by different technical needs and different types of chips. Nvidia still dominates that training, the phase of AI where those models learn from massive datasets. Training demands the most powerful hardware, those huge clusters of GPUs acting as one system, and Nvidia's platform is almost irreplaceable at this point. But then once a model is trained, the AI game changes completely. That's because inference, actually using the AI model billions of times a day, requires lower cost, higher efficiency chips. Companies don't want to spend $40,000 on a GPU just so a user can create a picture of Gandhi fighting the Civil War. That's why these ASICs and the edge NPUs are exploding, because they can develop 5 to 20 times better efficiency and far cheaper cost per query. So as that AI training and the inference diverge, the investment landscape will as well. Training GPUs from Nvidia and AMD are going to run into inference ASICs made by Alphabet, Amazon, Meta, and Broadcom, or adaptive FPGAs from AMD and Intel, and then edge NPUs from Qualcomm, AMD, Intel, and Nvidia, each type with the potential for multi-billion-dollar growth. That means the AI chip war isn't one front anymore, it's 4 different battlegrounds. And your next 10x stock is going to come from understanding which companies dominate in each area. Now, of course, Nvidia is still the leader in those high-performance chips for training. The company dominates in GPUs and has sold 6 million Blackwell chips this year alone, with at least 14 million more on order. Its next generation Rubin is set to release late 2026, maybe 2027, and it's developing its own edge solutions as well. But then here comes Alphabet, ticker GOOGL, probably the most surprising candidate here, developing its TPU ASICs, now on a 7th generation Ironwood. The company just signed a massive deal with Anthropic to train its AI models and is in talks with Meta Platforms to supply chips to it as well. Alphabet is dabbling in some of these other segments, but caught Nvidia by surprise on its TPU. Amazon, ticker AMZN, is also putting its $130 billion of operating cash flow to work, developing its own Trainium TPU chip and the Inferentia for inference. The company is building a data center for Anthropic with over 1 million Trainium 2 chips and claiming a 30% price to performance discount versus competitors. In fact, some of Amazon's AWS cloud data centers now use no Nvidia GPUs for its workloads. Broadcom, ticker AVGO, has been one of my favorite AI stocks for its lead in networking, but has also a strong contender in its accelerator chips. It's a back-end partner for Google TPUs, Meta accelerators, and OpenAI's coming custom chip, which means Broadcom doesn't really have to pick a winner here. Whoever wins the AI chip war will likely take AVGO along with it. Here, we bought into shares of Advanced Micro Devices, ticker AMD, in February, around $108 per share, before that huge 105% run since then. The company has come from out of nowhere with its MI series GPUs, with the 450 series winning major deals with OpenAI and Oracle. AMD is using an open software ecosystem versus Nvidia's closed CUDA, which makes it more flexible and customizable. AMD is also doing well in its legacy CPU segments, as well as its new edge product development. And before we compare these head-to-head and show you which stocks I'm buying, I think Qualcomm could be a dark horse candidate with its knowledge and potential in those edge NPUs. AI is soon going to be in everything you use, from phones to automotive, and that's where Qualcomm could find its moat. Now, you will notice I skipped several of these from the table. While Microsoft is developing some of its own solutions, it seems it's mostly relying on deals with others like Alphabet and Amazon, and I'm not sure the company really has much of an in-house team. Its Maya line has faced delays, so I don't think Microsoft is going to compete much longer in this chip wars kind of theme. Same thing goes here for Meta Platforms, ticker META, which is developing its own ASIC, but is also relying on others for its chips. I think it's a great stock for its own consumer electronics line that builds AI into its glasses, but I think for the AI chip wars, you gotta go with some of these others. Intel has its own Gaudi line of ASIC chips and is making headlines with deals as well as the government's involvement in the company, but growth is still not there, and I'm going to show you in our analysis next why I'm still not sold on Intel's future. I'm going to compare each of these and show you which ones I'm buying next, but if you've ever wondered what's in my portfolio or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. This is the app we've been waiting for, created for investors by investors. I've been using it for 2 years and love the app for getting ideas and sharing my own portfolio. Now here you can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across your entire portfolio. You'll also be able to join more than 500,000 investors in the social feed to see what everyone else is talking about. Now, I've shared my portfolio on the app. It is totally free to download, so look for the special invite link I'll leave in the description and check that out. Here I've created a spreadsheet for 10 of the big tech companies really competing in these chip wars. I want to walk you through, show you how to analyze these. I'm going to analyze these on 4 factors: revenue growth, operating margin, the valuation here, and then business segments. I think each of these are important, an important starting place really to start your research on these. Revenue growth, obviously, this is all about growth, folks. This is all about how fast these companies can take market share in this chip demand, as well as some of their other operating or business segments. The operating margin. Those of you in the nation know this is probably my single best or my single favorite factor for analyzing stocks, that operating margin. Again, that is the money left over, or it's the profit created from every dollar of revenue after paying suppliers, production, operating expenses like our research and development, like staffing, like marketing, advertising, things like that. What the operating margin shows you is not only management's efficiency and ability to turn that revenue into profits, but it can also be a clue into some of the competitive advantages a company has. Okay, if a company has a one-of-a-kind product that just cannot be replaced, it can charge pretty much whatever it wants on it, like we've seen with Nvidia over the last couple of years, charging $30,000, $40,000 for its Blackwell GPUs. And that's going to be a very high margin, okay? If it can charge whatever it wants out of its customers, but pay suppliers much less on its own bargaining power with suppliers, it's going to have a much higher margin. Okay, if it is also efficient in that R&D, in other operating costs, it's going to have a very high margin. So that's why we want to look at operating margin along with revenue growth. It's not all just about revenue growth and how fast a company can book those sales. It's also about that profitability. Then we also want to look at the valuation here. I like to use this price to sales valuation. Again, a lot of investors like to use the price to earnings instead. That bottom line earnings valuation, how much are they paying, the price for every dollar in earnings the company produces. I like price to sales because if you ever looked at an income statement, if you've ever studied finance, you know there are 1,000,001 tricks that a company can use to make its earnings look better. Accounting shenanigans, manipulations on that income statement to make income or net income or earnings higher than it actually is. Much harder to manipulate these sales figures, folks. So that's why I use the price to sales valuation, a little bit purer measure of a company. But then for these high growth stocks, you don't want to just look at a pure price to sales valuation. You want to look at price to sales to growth, okay, adjusted for growth. You know, we can see price to sales. Nvidia is one of the most expensive on this list. Out of this top 10, it is the second most expensive after Broadcom, trading at 34 times on a price to sales valuation. That would tell us, okay, compared to some of these other stocks, Nvidia is very expensive. But when you adjust it for growth, when you adjust it for that revenue growth, 56% annualized over 2 years, it becomes much cheaper. You are actually paying for that growth. So yes, you are paying a little bit more on a price to sales valuation, but you are getting so much more growth that it becomes a cheaper stock. And finally, I want to compare the business segments within these companies as well. This is something you don't normally hear about in these AI stock videos because it is all about that data center growth, the AI hardware and software, and of course, which Nvidia leads in. But what I'm worried about here is if that AI bubble does pop sometime. And like I've said in other videos, I don't think that happens for at least 12 to 18 months. And I've proven that in some of our other videos that I'll link to in the description below. But if something does happen to that AI stock bubble or the data center and the AI hardware and software growth, I want to be in stocks that have maybe some other business segments that are going to be able to support those stocks until the AI themes comes back. Okay, a lot of people comparing AI with the internet revolution of the 90s and the whole stock bubble we saw then. Okay, everybody in late 90s, including myself, when I started investing in 1999, thought that the internet was going to change our lives. We were investing heavily, and yes, it was a bubble, and it did crash. Some stocks, Amazon fell 90% from its peak of 1999 into 2002. But then what did we see? We saw the internet did change our lives. We saw Amazon change e-commerce as we know it, and those stocks are all worth huge money right now. So what I want is a stock or a company with other business segments that can support it while the AI revolution happens, while AI does change our lives, whether that's over the next 3 years or over the next 10 or 20 years, and stocks that are going to be around for that. Now, I've filled out this chart. I want to show you how to do this because I want you to be able to do this analysis for yourself. So what we're going to do here is walk you through this first one through Nvidia, how I got these numbers, and then compare each one and show you the stocks that I'm buying in this theme. First, we have the market cap. Okay, so market cap is just the total value of all the shares in the market. You can go here to any stock investing site and you can find the market cap here. For Nvidia, it's $4.5 trillion, 4,506,000, if you will, there. So I put that right there, $4.5 trillion in for Nvidia. Now that's going to be important for finding those valuations, the price to sales or the price to earnings. So market cap, $4.5 trillion for Nvidia. Then for some of these other ones, we're going to get the last year's sales and next year's sales with Nvidia. If you go here to the analysis tab on Yahoo Finance, or you can get this on pretty much any investing site. If we scroll down here, we'll see analyst estimates for last year's sales, which was $130 billion for Nvidia, and then next year's sales, $316 billion. Okay, so I want to put those 130 and 316. Now, this is not a 1 year estimate for sales growth. I want to get a longer term, something that can be held up longer term, more annualized, not just a one year product of the company. So I have this 130, I have the 316 for the revenue growth. I took the next year's sales expected by last year's sales actual. So 316 divided by 130, and then I annualized it with 0.5, okay? So what this is saying, with analyst expectations for $316 billion in sales next year for Nvidia, divided by last year's $130 billion, they are expected to book 56% revenue growth over these 2 years. This year and into next year, 56% revenue growth annualized for this company. For the operating margin, you can see here, I took the total revenue and the operating profit. Where you find that, you go here to the financials on Nvidia. Now, a lot of sites, including Yahoo Finance, you'll be able to find the operating margin, the gross margin in the statistics here. So here, operating margin, it says 63%. I always like to double check these because you never know what numbers the website is using. So I always like to go straight to the financials, straight to that income statement. Now remember, for the operating margin, the operating profitability, we're looking at how much money is left over after paying all the production costs and the operating costs. Okay, so total revenue, $187 billion over the last year for Nvidia. The operating income, here you have the cost of revenue, the gross profit. So that would be the gross revenue or gross margin. Then you got the operating expenses that come out of that. And here you have the operating income. So $110 billion operating income, $187 billion total sales. Here we go. 110 billion operating profit, 187 billion in total revenue. Divide that. So divide operating profit by total revenue gives you that 59% operating margin. Again, the highest we have here, very strong profitability from Nvidia because of its competitive advantages, because of the power it has over its customers, being able to charge pretty much whatever it wants for its GPU chips. And then the power over suppliers as well. Nvidia is a huge source for buying for a lot of these companies. So we can charge lower rates, get those purchases in scale, and pay less in operating costs. From just that, we're able to calculate the price to sales valuation. Okay, again, we've got the market cap, which is the price of all of the shares in the market cap of $4.5 trillion for Nvidia, divided by the sales, last year's sales. So we've got a trailing price to sales valuation. How many dollars are investors paying for every dollar in sales booked by the company? And we can see that right here, 34.6. Investors are paying $34.60 for every dollar in sales booked by Nvidia. Okay, very important valuation. Obviously, lower is better. If you can pay $10 or even $1 for every dollar in sales, like we see in shares of SMCI. If you can pay just $1 for every dollar in sales booked, you've got a one-to-one relationship. You're getting those sales for just $1. Paying $34 per share or per sale is very expensive on these. But then again, what I wanted to do, I wanted to adjust that for the growth. Okay, so we adjust the price to sales valuation by the revenue growth. Yes, it is an expensive stock, but it is growing so fast that when you take into account that growth, it isn't as expensive as it may appear. And here for each of these three factors, I've highlighted the top three in each. So for revenue growth, we've got Nvidia leading the pack, 56% annualized growth, but we've got Advanced Micro Devices, AMD, and Marvell Technology, 31%, bringing up the second place very quickly AMD, Advanced Micro Devices CEO Lisa Su, actually said she thought they could do 35% revenue growth over the next couple of years. Again, AMD surprising everyone with its GPUs with some of the deals it's been signing. You've got some of these others, Broadcom and Meta Platforms, each doing very good 20% plus revenue growth. The rest of these a little bit lower. Alphabet, Microsoft, and Amazon into the teens for revenue growth. And then Intel and Qualcomm, 1 and 2% revenue growth expected over the next years. This is really why I'm kind of avoiding shares of Intel and not really excited about Qualcomm, even though they could have the advantage in those edge NPUs, in the edge AI chips. But really focusing on these top three, as well as maybe looking at some of these others. I think Alphabet, Microsoft, and Amazon, probably a little bit lower revenue growth just because they're in so many other business segments. I'm going to talk about that. So a little bit lower revenue growth, but much safer, much more stable. And I really like some of the other terms on these, some of the other fundamentals on these. In profitability, again, Nvidia just cannot be beat there. 59% operating margin. Of course, that's attracted a lot of these others to that chip competition. When you can get a 59% operating margin against the operating margin in some of these other big business segments, of course, you're going to see if you can compete in that segment and get some of that profitability. Here, Microsoft doing very well too, though. 46% operating margin. Meta Platforms, 43%. Here we see Alphabet does well at 32%. Broadcom, 39%. Nothing to shrug at either. Qualcomm, up 28%. Again, Intel is the laggard, 0% operating margin. In fact, they are at a loss, operating profit of negative $104 million. I don't see that turning around anytime soon. So even though the government wants a piece of Intel, even though it's done very well this year on that rally, that rebound, I wouldn't take a chance on Intel at this point. Then when we look at valuation and adjust these for growth, we see some very surprising numbers here and very cheap stocks on a relative basis here. Price to sales to growth, Amazon just 0.33 times there, 3.8 times on a price to sales. So it is one of the cheapest next to Intel, one of the cheapest in just that pure price to sales valuation, but then adjusting for that growth. Even though the growth is only 12% annualized, it is very cheap. It is one of the cheapest or the cheapest here among our 10 stocks. We also see here Advanced Micro Devices. Even the 105% return it's done this year, it is still one of the cheapest of the 10 AI chip war stocks that we're looking at here. Marvell Technology doing very well as well. But then here we have Nvidia, not as nearly as expensive as it would appear on that price to sales valuation. Okay, adjusted for its huge 56% growth, that it is still cheaper than Google, Microsoft. It's cheaper than Broadcom. It's cheaper than Intel, which does not have profits anyway. Cheaper than Qualcomm. So it is still a very good deal here for shares of Nvidia. But again, I also wanted to look at business segments because I think the main weakness of Nvidia, if you could call it a weakness, is that it's so focused on those AI chip wars, on AI hardware and software, as well as some minor plays there in gaming and consumer electronics. But it is so much focused on AI and hardware and software. If the AI bubble does pop, or if the demand for some of those chips does come under what we expect over the next couple of years, Nvidia will be the stock to get hit. Okay, whereas some of these other stocks, Alphabet has its Google search and ads, it has its cloud services. It's also in that AI hardware that is doing very well, but it's also in Android, consumer electronics. It's got its robo-taxi within its Waymo unit. Here with Microsoft, we've got cloud services, AI hardware, enterprise software, social media through LinkedIn, and gaming. We've got some of these other ones that I like. I really like Amazon here, the leader in e-commerce, the leader in cloud services. Its advertising segment is its fastest growing segment, as well as just its logistics and consumer electronics. So if I had to pick maybe 4 or 5 stocks from this list, 4 of the top 10 here, one, I would have to go with the Nvidia. Okay, that revenue growth of 56% annualized. The operating margin is untouchable here. Yes, it is more focused in AI hardware and software, but as I've shown in some of our other videos, we have at least 12 to 18 months for this AI bubble to keep inflating, for that demand to keep going, maybe even longer if some of those expectations for AI use and returns do come through as expected. So it's harder to bet against Nvidia here, especially at this price to sales to growth valuation. I'd also be going for Amazon here. Amazon doing very well with its Trainium chips in that AI hardware space. but also very much a player in e-commerce, the leader in e-commerce, cloud services. Again, advertising, a very strong growth there, and one of the cheapest or the cheapest among these top 10. So I think you buy in shares of Amazon here, even though it's only got 12% annualized revenue growth expected, it is a leader in so many of these segments, and the price is just right for this. Again, Broadcom, even though it is fairly expensive here on a price to sales, even on an adjusted growth basis, it is one of my favorite stocks in this AI theme, not just with this AI hardware with its accelerator chips, but also in the networking, one of the big bottlenecks in data center infrastructure. And that build out is that networking and the hardware and the software we need. Broadcom is bar none the leader in networking, but it also has its own semiconductor solutions, its own enterprise software, and the operating margin is very strong here, 39% operating margin, so doing very well as far as profitability there. And surprisingly, AMD, even after the 105% run that we've seen this year in our own portfolio, still priced very attractively, 0.45 on that price to sales to growth, that adjusted basis. Very strong 31% revenue growth, so tied for second there among these. I think it goes higher. I think it goes to 35%, which is what CEO Lisa Su said we could get. The operating margin, that is the one that worries me, but I think that actually surprises on the upside. I think AMD with its 450 series, I think it starts having that competitive advantage in those GPUs as well as some of the other products it's launching. I think it's able to raise its prices. I think it gets that operating margin up, and I think that shocks Wall Street. I think that keeps these shares keep on going up. Join me on the Blossom Investing app with the special invite link in the description below. See every stock in my portfolio and join more than 500,000 investors to see what everyone is talking about. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.